This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, July 2nd, at about 7:20 Mountain Time. Our note this week was titled The Policy Mosaic, and very importantly, something we do once a quarter. We placed it outside of the client paywall. So we urge you to go have a look at the note and see everything that becoming a full subscriber would provide you with on a weekly basis. Our equity sector allocation, our asset allocation tables at the end, and very specific recommendations on how we think you should be positioned. So the note, as I said, was titled The Policy Mosaic. I'm going to try and keep these comments relatively brief because we'd like you to spend your time reading the note rather than watching this video. The first section was titled An Unstable Equilibrium, and we went through the transition from the markets focusing on one BBBA, one Big Beautiful Bill Act, to focusing again on trade. We had forecasted a month ago that based on the analysis we'd read, and we included a congressional review, that the use of the International Economic Emergency Act was likely to be declared unconstitutional. We think the Supreme Court will likely hold that up. And the net effect of that is that the focus is going to turn to country-specific tariffs, perhaps using Section 338 of the infamous Smoot-Hawley Act or Section 122 of the 74 Act, which would be more product-specific. And sure enough, the Trump administration on Friday turned up the heat on China, turned up the heat on steel, so to speak. And but for us, what that does is it takes some of the worst case scenarios off the table. Things like getting to a 25% global tariff, we think now is fairly improbable. So that's the net effect of all this is a bit of a positive, because when we look through the policy mosaic, fiscal policy, we remain concerned about government spending. There's not enough that's been cut, and we don't think they can get there all the way through discretionary spending as they go through the annual appropriations process either. So we're a bit negative on the spending side, and as a consequence on the fixed income market. But the tax policy, we do think, will be a positive for our outlook for capital spending, which is a recovery in the second half and perhaps even a secular boom through the business cycle. So that's a net positive for equities, in particular the sectors that are beneficiaries of that, like industrials, financials, technology, energy, and materials. But monetary policy is a big consideration for us. We still think the Fed has a very unbalanced policy that's putting a burden of tighter rate policy on small banks, small businesses. Please go through our entire discussion on that in the note. And that remains a drag. The data last week, we went through the regional Fed manufacturing data as well as the Conference Board survey, which we pay a particular focus on the labor portion of that. And we don't like the hard data, soft data moniker. We prefer survey or sentiment data versus activity data. But on balance, the soft data got harder. There was some improvement in capital spending plans for manufacturing businesses 6 months forward. But the hard data got softer. And so, looking through the core details of GDP, durable goods, pending home sales, all that stuff got weaker. So again, go to the note for the full details here. We then had a really interesting discussion of Fannie and Freddie. We know a lot about Fannie and Freddie from our days at Lehman Brothers, and we're not really keen on them being released back into the wild without significantly shrinking their footprint in the housing market. Again, go to the note for the details. It'll be part of our book when we ever get around to writing it. But Fannie and Freddie's role in the financial crisis was absolutely crucial. The whole subprime boom could not have occurred without Fannie and Freddie taking down 40% of every subprime CDO deal and they took down the uneconomic tranche that only worked because they had excessive amounts of leverage because of the implicit government guarantee. So we have lots of issues with Fannie and Freddie. We have nothing to say about the stocks specifically if they're going to be public. We have no details. We have no way to analyze that really at this point. So on balance, we don't see a lot to do in the markets right now. We do think if we get softer labor market data, another round of soft inflation data will get closer to the Fed starting to cut rates. That could be a big boom for small banks. We do think we're going to hear more on bank regulatory loosening in recent weeks. So we'd keep our eye on that sector in particular. We noted that the tech revisions are getting much better. So the tech sector fundamental momentum looks good. Obviously, the group is expensive. And we're a buyer of stocks on weakness and a seller of bonds on strength is our net position. Barry Knapp from Ironsides. Again, I urge you to go look at the note and consider becoming a full subscriber. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.